All right, fire away, my friend.
Okay, excellent. So again, my name is Ray Chouinard. I'm a senior loan officer with Draper and Kramer Mortgage, and you can see my website address there, raymortgage.us. As you can imagine, with everything that went on with COVID, a lot of stuff is done electronically these days. So raymortgage.us is where I always send a lot of my clients. It's just a web address that will forward them right to my secure company site so that they can go on and they can fill out the initial application. They can upload documents, anything that they need to do along the way. So thankfully, when we had to switch everything to digital due to COVID, our systems were all set up so that the clients could navigate that without the in-person contact that we usually have. A little bit about me. I've been in the mortgage business for 22 years now. I'm licensed in Massachusetts. That's where I do most of my business. I'm also licensed in New Hampshire. I do quite a bit there. A little bit in Maine, and I recently got my banking license in Florida as well. But I'm able to help people out. My company is licensed in 46 states right now, so I'm also able to help people out mostly across the country by partnering up on the mortgage process with them. And then lastly, the last 2 years, 2020 and 2021, I was recognized by Mortgage Executive Magazine as one of the top 1% in mortgage volume for people at my position. So quick little meme here, as we all know from being in real estate. People think it's not stressful, but it certainly is. So one of the things that we were just talking about before we got started is questions about appraisals. And I think what we're going to see this spring and this summer is going to be pretty much what we've seen the last 2 or 3 years. Home values are continuing to go up. So we may have to deal with the question of what do we do when the appraisal comes in lower than the sales price. So number of different things that we can do here. I always tell people, if you get in a situation, especially with a buyer, where you think that might happen, where it's 10, 15, 20 offers, and we think that the final bid might be something where it might not appraise out, definitely have them reach out to their loan officer right away, maybe even before the offer goes in, to say, let's just look worst case scenario. If this thing doesn't appraise, what does that mean to me? And I'm going to show you a couple of things that we can do as a recourse in the following slides. So one of the first things to know is that an appraiser must entertain a rebuttal. So, you get a sales price of $800,000 and the appraisal comes in at $775,000. One of the first things that we do is we send that appraisal off to the buyers and say, share this with your buyer's agent, see what they think. Maybe the buyer's agent will work with the listing agent to review the appraisal and, kind of come up with some thoughts. They might come to the agreement that it's a good appraisal. It is what it is. The property is going to appraise at 25,000 lower than the sales price. Or if they look at it, they might find that the appraiser just missed some stuff. There's maybe a comp that the realtors thought would be used on the appraisal report that wasn't. Maybe there was a for sale by owner that the agents knew about, but for whatever reason, the appraiser didn't know about. So it's important to know that you can always rebut an appraisal. And the way that we do it at Draper and Kramer is we get any supporting paperwork that we would get, usually from the realtors, that would say, could you please tell us why, this comp wasn't used, or we disagree with, the adjustments on this comp. I send that off to an underwriter, and then the underwriter has to send that directly to the appraiser. So it's important to know that, whether it's my company or another company, any loan officer cannot have direct contact with the appraiser when it comes to anything to do with value. So number two here, discuss the implications with the lender. Again, it could be an easy fix in some cases. So let's take a peek at one solution. And it's important to know that when an appraisal misses, let's say that you do the rebuttal, everything stays the same. And let's go with my example here that we'll see on the screen, which I'll pull up here. Let's say you have a $500,000 purchase. Client was planning on putting 20% down, so they're going to finance $400,000. So let's say that their principal and interest would have been $1,686. Now we get the appraisal report. It comes in at $480,000. We've done a rebuttal. Everything stays the same. Value is not going to change. The appraisal is going to be $480,000. It's important for agents to understand that that doesn't necessarily mean that, the client now has to come up with an extra $20,000. That's usually the knee-jerk reaction. But in this case, and this is an example that I had a year or two ago, appraisal came in at 480,000. So I told the client, I said, listen, you can keep everything the same. You were going to put 20% down, which would be $100,000. You can do that $100,000 down. You can keep everything the same, but just understand that as a lender, we now have to go off of whichever is lower, the sales price or the appraised value. So if we go off of the appraised value, you no longer technically have 20% down. So if we took that $400,000 loan amount and divided it into the value of 480, their loan to value might be, 82 or 83%. So what that would mean is that they would need PMI. So in this particular example here, I looked at the client's numbers. They had pretty good credit. We were able to do what's called a lump sum PMI for them. So it's a one-time cost of $3,000. So it's not monthly. There's nothing to, there's no surcharge that gets added to their mortgage. There's nothing to get rid of years down the road. It's a one-time thing which can be paid in cash if the client wants to, or they can put it into their mortgage. So in this particular example here, appraisal came in low. It wasn't changing. This client's total PMI came out to $3,000. So all we did was add it to their loan amount. So instead of financing 400, they financed 403. And you can see in the blue category there, it changed their monthly payment by $15 a month. So it really wasn't that of a big deal whatsoever. And that's a lot of what happens with these. This is a lot of what we'll go over with clients, prior to putting in an offer, if they have a feeling that it may not appraise out. A lot of times this is the answer. It might just be a little bit more expensive PMI or some PMI that they didn't have with 20% down, but it's not always a deal killer. Again, the knee-jerk reaction tends to be, oh my God, the client has to, pay this extra amount, and that's not always the case.
Or we have to go back and negotiate.
Say that again, Richmond?
Or we have to go back and negotiate.
You could go back and negotiate. Obviously these days you're seeing a lot less with, the offers having the verbiage that the place must appraise at or above the sales price. Right. We hardly ever see that anymore. You could certainly go back and renegotiate, but this is what I find is this is kind of the deal saver in most cases where we just go back and say, listen, everything can stay the same, but here's what's going to change. You're going to have a little bit more PMI, or it's not always the deal killer that people think it would be. Now there are certainly cases, and we'll talk a little bit more in a couple screens ahead about lower down payment loans. If somebody was doing a 100% financing or a 3% down financing, then it could cause their loan to get denied because there may not be any recourse. You can't do a loan at 103% loan to value. You can't do a loan that's more than what the purchase price is. So there are some rare cases where it would cause the loan to be denied if nobody moved and lowered the value. So talk a little bit about PMI. So PMI is private mortgage insurance. It's required on mortgages that have less than a 20% down payment. So as you saw on the previous screen, it can be paid monthly or it can be paid in a lump sum. Most people traditionally think of PMI as this surcharge that they have to pay monthly, but depending on how much the person's putting down, depending on their credit score, a lot of times we're seeing that this lump sum PMI, whether they pay it in cash or whether they put it in their mortgage, it can be a really cost-effective way to tackle having PMI. It can be paid in a lump sum. It can be paid in full by the buyer at the closing table, or it can be financed into the mortgage. There are actually other cases where if you can do a seller credit, the seller could pay for it. There are cases where we can increase the person's interest rate slightly, and we can actually pay that for them. So for the right client, this lump sum PMI, it can be a great way to keep the cost down on the monthly payment.
Ray.
Yes.
And this may be a silly question, but on the last slide where the example you gave was, in all relativity, kind of a short number.
Yeah.
Like they were only off by 20,000. Like I'm assuming that lump sum payment increases if the appraisal gap, as the appraisal gap grows, right? Like
It will. Yep.
Yeah.
You're going to see on one of the next slides, that'll probably be a little bit more clear. Let me just get to that one. So let me go back to this one for one quick second, just to kind of put a bow on this part of it. So if somebody chooses to have monthly PMI, the way this works is they're committing to that PMI payment for usually at least 2 years, because the thing with PMI is it's not just that you have less than 20% down. They want to make sure that you pay your mortgage payment on time as well. So if somebody decides that they want to have a mortgage that has monthly PMI, after they've made 24 on-time mortgage payments, they could apply with their bank or lender to have that PMI removed. So if they can show that they've made 24 payments on time, and now they probably would have to get an appraisal done, whether that's a full, appraiser comes out to your house, or if it's more of a desktop type appraisal, they'd have to show that they've made the mortgage payment on time and they now have enough equity over those 2 years to get rid of the PMI. So to go over your question, the cost of PMI can be.
Oh, there we go.
All right, so let's say that, let's start at the very bottom, okay? So 85% and under. So this would be an example of what I just went over. So if you look at that last box and you scroll over to that where the figure says 0.62. So let's say that, in my example, the property doesn't appraise, it's off by a little bit, and now their loan to value is maybe 82%. They're going to fall in this box, and this is how every lender would price out their PMI. So in this particular example here, somebody that had an 82% loan to value, let's say, if you look at the top, all of those numbers up there would relate to their credit score. So 760 and above, 740 to 759, et cetera. In this particular example here, their total PMI would be 0.62% of their loan amount. So that person who has good credit, the appraisal missed by a little bit, nothing's going to happen. I would be able to tell them, okay, here's your lump sum PMI. Here's what the cost is going to be. Now, let's stay in that box 85 and under and scroll all the way over to the right-hand side. So you can see that this cost starts going up based on the person's credit score. So that missed appraisal for somebody who has a lower credit score between 620 and 639, their lump sum PMI could be 1.62% of their loan amount. So it's going to be more expensive. And this is why I would always tell people to say, if you in a situation like that with a buyer and you think that the appraisal, may not work out, this is why they want to talk to somebody like myself to go over these numbers, because it's not going to be one size fits all. That person who has a 760 or above credit score is going to have a lot lower lump sum amount than somebody who has, just a fair credit score. And then you can see, to get to your question, Richmond, too, you can see if you go up, let's say the appraisal misses by a bunch. Now, all of a sudden, we're falling into that 85 to 90% category. The less equity you have, the more expensive the PMI turns out to be. So, in that case, that person with really good credit scores, their lump sum PMI might now be 1.2% of the loan amount rather than the 0.62. And then if you scroll way over, you can see that person who has a lower credit score, it's going to get a lot more expensive. Again, not always a deal killer, because even when we work this out, if you worked out, let's say you had $8,000 worth of PMI, that's probably going to translate to about a $40 difference in the person's monthly payment if they finance that into the loan.
Right.
So it's really not always the deal killer that people think it would be.
And then another question: is it always an option to do lump sum or finance, or will sometimes it not be an option to finance?
So most cases it would be. The only time it gets a little bit tricky is, let me pull this back up here. See this box here that goes 90 to 95%?
Mm-hmm.
You can't finance it in and go over 95%.
Right.
Okay. So this lump sum PMI, forget about the whole, it didn't appraise this and that. It always works best when somebody has good credit and at least a 10% down payment. That seems to be the sweet spot. I've done a lot of those, 10% down with the total PMI coming out to somewhere between 1.2 and 1.71. That's kind of the sweet spot. You can
Okay.
do it, if you had somebody who's putting 10% down and the place missed by a little bit, now we'd have to go up to that 90 to 95 box. You can still finance it in at that point. But if you have somebody putting 5% down and it doesn't appraise, that's when it gets tricky. You really can't finance it in and go above 95%.
Gotcha. And again, obviously the conversation with the client would be talk to you. Like, I'm not going to answer these questions for you.
Exactly. And that's a lot of what you're going to see too in this 2-hour presentation. These aren't things that you necessarily need to know, because you're not going to know things like this. You're not going to know, you're going to know how much money they're putting down, but you're not going to know their credit score. You're not going to know their debt to income ratios. That's the stuff where all you would really need to do is say, go talk to Ray or go talk to your lender and say, what's going to happen if this doesn't appraise? And, that's a conversation that we're having with people, a lot of times now when they get in these bidding wars, because it's going to be dramatically different depending on, how much they put down and what the credit score is, as you can see.
Okay, cool. Thank you.
Okay. Any other questions on that at all?
No, that again, I've been with clients, they always get so worried that I have to come up with this huge chunk of cash. And to be honest, like even at 20% down, you kind of think that's really the only option because it's the only option anyone ever explores.
Exactly. Yeah. And that's the thing. I feel like even though we've been living in this world now for 2 or 3 years with, all these over askings and, 15, 20 offers, I feel like there's a lot of people that still defer back to that old thinking of, oh my God, it missed by 20 grand. My buyer doesn't have another 20 grand to kick into the deal. What are we going to do? Again, unless they're putting a really, really low amount down or doing something like a VA loan or 100% financing where there is no down payment technically, there's a lot of ways to work around that lower appraised value.
Yeah.
Okay. On the other side of the coin, appraisal waivers. So I don't know if you guys have seen these at all, but they're becoming a lot more popular. Basically what it is, most of the banks and lenders around here, we all tend to use the same underwriting software. We're gonna underwrite the client's loan either on the Fannie Mae or the Freddie Mac underwriting engine. And every now and then it will give us an appraisal waiver. Basically what it's doing is it's saying that they're looking at all the data behind the scenes. I tell people it's kind of like they're doing sort of a Zillow search on steroids, where they're saying, if you're telling me that this is the sales price of this house, this client's putting X amount of dollars down, they've got a good credit score, they've got low debt to income ratios, the computer system is saying we're comfortable that we don't need an appraisal. So you'll usually see these on single family homes with 20% down or more. Again, it's doing a search behind the scenes just to say, does this value seem right for the area? But it also has to, it also factors in the client themselves. Do they have good credit? Are they really pushing the envelope with their debt to income ratios? Are they fairly low? So we're seeing a lot more of these. And what's good about these, when they're done correctly, is that we can actually pre-underwrite the loan. So let's say, and I did this like 2 weeks ago on a Friday. So I had a client who was making an offer on a property. She was putting 30% down, knew it was going to be a competitive offer. So we went into the computer system. We put the address in. We put all the specs about the property taxes, condo fee, all of that. We put that in the computer system, and we kind of played around with it. I said, okay, what do you think the most that you're going to offer on this property would be? We got to that number, and we put in 30% down. We underwrote the loan over the computer system, and it said that we wouldn't need to do an appraisal. So she was actually able to put her offer in and know that she could do an appraisal waiver to make the offer more competitive. So
wow,
just one of those tricks that I wish more people would reach out and do, but it's one thing that comes up a lot with clients when I meet them nice and early, and I can have that conversation with them and the realtor to say, okay, we have all of your stuff. If you think this is something that you want to do, give me the address of the property. Let's figure out, the most that you might offer on this. Let's go in and we can probably put in the offer, that you'd get an appraisal waiver up to X amount of dollars. So we're seeing that more and more. Anything to show the seller, you guys know, home inspections are getting waived these days. We're seeing, mortgage contingencies are even getting waived. Appraisals are getting waived. So It's just, one more nugget we can try to have in there if needed, if it's going to be a competitive situation. So obviously the question for the last couple of weeks, couple of months is, why have mortgage rates been climbing so quickly? So the short answer here is just inflation. They were already going up at the start of the year, just based on gas prices heading north. And inflation is basically the arch enemy of mortgage rates. The higher the inflation goes, the higher gas prices go, the higher mortgage rates are going to go. So one thing to point out, though, as we sit here on March 18th of 2022, probably heard on the news on Wednesday that the Federal Reserve raised quote unquote interest rates. So the first time that they've raised interest rates since 2018. It's important to know, and again, not necessarily something that you guys need to know, but your clients need to know, that when the Fed does that, whether they're raising rates or they're lowering rates, it doesn't have an immediate impact on the 30-year fixed rate. So at 2 o'clock on Wednesday, when you heard all over the news that the Fed raised interest rates by a quarter, it doesn't mean that everybody's 30-year fixed rate went up by a quarter. In fact, a lot of times mortgage rates will actually come down, because what the Fed is doing is they're lowering short-term interest rates. They're lowering the amount of they raised it this week. When they raise their interest rates, they're raising short-term interest rates. So they're raising the rate on the amount that they borrow money from each other on what's called an overnight basis. So just one of those things to kind of keep in the back of your mind when you hear the Fed's raising rates. They're not immediately raising the 30-year fixed rate. Same thing when rates go down. All through COVID, when we heard the Fed was lowering interest rates, my phone would ring off the hook, from clients who are in process, or clients who've been thinking about refinancing, thinking that the 30-year fixed rate just went down, and it actually doesn't work that way. So what they're really doing, and what they're projecting for this year, is they did the first rate hike on Wednesday, the 16th. They're projecting that they could do as many as 7 rate hikes this year, and they're doing that to try to bring inflation down. So although we're going to hear, rate hike a bunch of times this year, you may actually see the 30-year fixed rate come back down a little bit, because inflation will start coming down with those rate hikes.
Is that, can I, and this might
Yeah,
not be germane to this, but since it's just the three of us here,
sure.
Because I actually got a call this morning from a buyer who had a question about, because on the news this morning, I guess it was all, the sky is falling, interest rates are going up, like it's the worst time ever to buy a house, blah,
Yep.
blah, blah, blah. Is that the kind of elevator speech you would give, what you just said about when you're talking to a potential client or a client, or should
Absolutely.
we refer them to you?
Yeah.
This isn't anything we can't speak about, right? We should be educated on this stuff.
Exactly. Yeah, absolutely. Yeah, no, I would always tell, again, I always tell people, I could have 10 different clients that are looking at the same price range, and they could have 10 different interest rates, depending on the credit score, how much they're putting down. So it's one of those things where, for you, again, having that elevator speech, it's a good time to say to them, why don't you reach out to, your loan originator, or, reach out to me if they're not working with somebody, and just have that conversation, because it doesn't mean that long-term interest rates just jumped up. In fact, the markets that we watch, and a lot of people don't realize that, watching mortgage rates, it's like watching a stock. They can change daily. They can change during the day sometimes. So what we watch is what's called mortgage-backed securities. It's like the stock market for mortgages, and they've actually done pretty well since that announcement on Wednesday. So we may even start seeing rates come back down a little bit. And one of the things too is that remembering that there's always a lag time. So we're going to talk in a couple slides ahead here just about, the differences of mortgage rates and advertising and things like that. But it's important to realize that there's a lag time. So once a week, Fannie Mae or Freddie Mac might come out and publish the average 30-year fixed rate for that week, but there can be a lag. It might come out on Thursday, and there could be some earth-shattering news that comes out on Friday that moves the rates up or down a little bit. So there's always lag time. It's always tough for the consumer to get a handle on exactly what the interest rate should be without talking to their loan person about their specific scenario. It's easy enough for me to log into somebody's file, see their credit score, see their down payment, and say, here's what your rate would be today. It's very difficult to give one interest rate with one broad stroke.
Ray, do you think that all that's going on over in Russia, do you think there's any impact on the Fed's decision as to how much they bump the rate?
Could be. Could be. I think there's a lot of people that were kind of shocked that they didn't do a 50 basis point rate hike right now, just because things have been spiraling out of control. I mean, how often do you see, inflation at 7.9%? They typically, the Fed likes to keep that under 2%. So I think depending on what happens with Russia, it's probably going to have more of an impact at their next meeting rather than this one. But I think there are a lot of people that were I think if they did a 50 basis point hike at this particular meeting last Wednesday, their concern is it might have confused the market too much because everybody, the stock market, the mortgage market, everybody had priced in at least a 0.25% rate hike. Everybody knew that was coming already. I think that they got concerned that if they did a 50-point rate hike, they might see one of those days where the stock market goes down 1,000 or 1,500 because people are confused by it.
Yeah,
But
makes sense.
the longer it drags out, it's going to depend on, what the gas prices keep going. That's going to control everything. If the gas prices keep spiking, inflation's going to keep spiking. And, I think the next Fed meeting, and I don't know I think it's in early May. I think that one there is going to have more of a Russian impact if this thing drags through April.
Now, how can they increase the basis by so much?
Yeah.
In other words, is there a cap? Is there a ceiling that they can't go above?
I don't know that there is one. I'm trying to think back to, they made quick, sharp moves when COVID first broke out. I think, and they don't. So I don't know if there's a cap on it. I don't think there is. I think it's more of like an internal cap to say we know we need to do something up or down right away, but we also need to be mindful of not causing everybody to pull all of their money out of the stock market and put it under the pillow.
Right.
So I think what they did in the height of COVID, I want to say that they did like an emergency 3/4 point drop. It was at least a half, but they might have done a 3/4 point drop. And they don't always have to do it at a Fed meeting. Like what they did this week, everybody's had March 16th on the calendar forever. We knew that that's when the Fed meeting was. We knew they were going to do it for a quarter. But when you have these really crazy situations, like you could even see Russia escalates and things keep going south, you could even see them do an emergency rate hike, somewhere between, now and the next Fed meeting.
Mm.
They have to, it's kind of the seesaw. They have to do those to, pat down inflation, but they also have to be mindful not to make people panic and not have one of those, extreme days in the stock market where they lose, quadruple figures.
Right. Makes sense.
Yep. All right, we'll stay on mortgage rates for a little bit. So, I like to tell people they're kind of like mortgage rates. When you look online, they're like dating profiles, pictures. They look good at first, and then you look into it more, and you're like, this doesn't look so right. So, again, the thing I always tell realtors, I tell buyers, make sure you're getting a rate that is specific to your scenario. You can't, you just can't paint these things with one size fits all. So a couple of slides that I like to show in these presentations are, think about that buyer who is getting the daily email updates with different properties, or if you know that person who just kind of logs on every day and is, Googling a property address when it comes on the market. One of the things that's really frustrating is that, and this is a little bit of an older slide, but this is probably from a year or two ago, but this property was on the market. And I logged on one morning and I said, let me just Google the address. And I'm going to look at the first 4 or 5 websites that pop up. I'm going to go into those websites in no particular order, and I'm going to look at the sample mortgage payment and see what it comes out to be. So this first one here, I don't even remember which company this one was, but for this property, you can see the bottom right-hand corner, they were showing an interest rate of 3.134%. So this was giving the client a sample mortgage payment. They're almost always going to default to 20% down. So I always tell clients, again, make sure if you're just doing this on the fly, this isn't going to be helpful for you if you're putting 5% down. All these websites will typically defer to 20% down. So this example here, 20% down, an interest rate of 3.134%. This person's principal and interest, if you look in the upper right-hand corner, would be 1712. Now, same exact property, different website. See the highlighted in the left-hand corner. Same property, 20% down. They had a sample interest rate of 4.25%. So it made the mortgage payment $1,964 for the principal and interest. So almost $200 more than what we saw on the website above. So just one of these things that I always tell realtors, I always tell clients to make sure, again, that they're reaching out to their loan person. I like to talk to all of my clients on stuff like this. One of the things I do a lot of on Fridays is, and I've done it already this morning, is I go over exact mortgage payments with people if they're looking at properties over the weekend. So I'll send them their own personal little snapshot like this, just to make sure they're working with real numbers, because there's nothing worse than, and I had this happen a couple of weeks ago, nothing worse than somebody who's going on these sample websites, not realizing all the parameters and how they're set up. I had a woman who's been looking at 5% down. She sent me a property, said, I think this is in my budget. This place is great. This is everything I'm looking for. When she sent me a snapshot similar to this, I had to call her back and point out and say, well, you got to realize that this is 20% down, and your credit score is average. It's not perfect, and these mortgage calculations are always going to assume a perfect credit score. So when I went through the numbers with her, it was like $500 more than what the sample.
They're a little different. A little different.
Big difference. So there was a little bit of tears on the other end of the phone on that one, unfortunately. So I always caution people, what they're looking at, to make sure they reach out to their loan person to make sure they're getting accurate quotes. All right, so most of what we talk about and most of what we've seen so far is we're talking about what's called a conventional loan. I like to refer to it as something that's vanilla. So typically the guidelines are put in place by Fannie Mae or Freddie Mac. Those are the two government entities that write all the rules and regulations on mortgages. They're usually pretty consistent. They're the ones who kind of dictate, 5% down, 10% down, 20% down. So when you hear about someone like myself talking about an online underwriting system, that's what we're using. We're underwriting that loan on the Fannie Mae or Freddie Mac underwriting engines on their website. The way that they're all set up, as you saw in some previous slides, the highest credit scores get the lowest interest rates. And if they have to have PMI, they're going to get a lot lower PMI for the higher credit score that they have. Typically on a conventional loan, your usual starting point is about 5% down or more. Now, there are some conventional loans that you're going to see shortly that you can do less than 5% down, but for your typical vanilla 30-year fixed, 5% down is the starting point. And the last thing here, I actually have to update this because this number has changed recently. In Essex County, the single family conventional loan limit is now $770,500. So anything under that, you're looking at 5% down, best interest rates available. So a little bit crazy now to think that you can get a regular conventional loan. You can buy an $800,000 single family or condo with 5% down and get a regular conventional loan with the best rates available. So again, that number here in Essex County is now $770,500. So a couple of loan programs out there, mostly for first-time home buyers. You can purchase a property with less than 5% down. Again, these are regular old conventional loans. Fannie Mae has one called Home Ready, and then Freddie Mac has one that's called Home Possible. So as you can see here, they do have a couple parameters. Both of them would allow a purchase as little as 3% down on a single family home. Now, it must be owner occupied, and on the 3% down option, they have to be first-time home buyers. So there's a lot of variations of this mortgage, but for the purposes of this today, focus on the 3% down. This would be that client that wants to buy that single family or condo, and they just don't have a whole lot of money saved up yet. Again, it has to be owner occupied. And one of the benefits of this is if they qualify for this mortgage program, they get drastically reduced PMI and they get slightly lower interest rates. So when somebody fits in the box for this, it can be a really good mortgage program. I'll show you how they have to fit in the box here. So somebody's looking at a property, and I'll pull this slide up. both Fannie Mae and Freddie Mac have a loan lookup website. This one on the screen here happens to be Fannie Mae's version. So in this particular example, I put in, a client was looking at 14 Cedar Street in Waltham. And as you can see, the middle of the screen there, it's saying the home ready income limit is 91,200. So to qualify for this particular mortgage, the person, or if there's a couple, together, they're combining incomes, they would have to be making less than $91,200 to qualify for this home ready program, to put 3% down and get the lower interest rate and drastically lower PMI. So it's a good mortgage program. However, you can imagine with the prices that we're seeing these days that, in most cases, I live in Beverly, my office is in Danvers, finding a house in Danvers for sale for a single family home, you're probably going to have to be making more than 91,200 to qualify for that house. So it's a great mortgage program when it fits, but it's all done by address. Every neighborhood, every county can have a little bit different variation on that annual income amount, but I've seen most of these being used these days in like a Haverhill, Methuen, Lawrence, where you can still get a property and qualify and be making less than 91,000. That seems to be around the number with them. It pretty consistently comes out to like 91 to 95,000. But that's the first place we start. We always look at the Fannie Mae loan lookup tool. Freddie Mac has one that's similar, and 9 times out of 10, the cap on the annual amount that you can make, they will usually mirror each other. So good program for those people who fit into it. In our footprint here in Essex County, you're seeing it used a lot less just because you need to be making a lot more money to qualify for the sales price. So another version of first-time home buyer loan that we have here in Massachusetts is what's called mass housing. Most of the people who will do a mass housing loan, they're going to be first-time home buyers, and they probably have a lower down payment need. In some cases, your typical mass housing buyer is going to be buying a single-family home or a condo, and they're going to be looking at 3% down. So there are courses that they have to do, and you'll see in the next slide there are income limits as well. So it's a regular old, in most cases, 30-year fixed rate. So there's nothing crazy. It's a regular conventional loan. In most cases, it's underwritten behind the scenes according to Fannie Mae and Freddie Mac guidelines, but it's a way to let someone buy a single family or condo with 3% down. Now, mass housing, the one thing I always tell people, and I tell realtors all the time, is that if we have buyers that we're working with and we know that they're pre-approved for mass housing, if things are dragging out a little bit, they just are not getting their offer accepted, I always try to go back and look at any new guidelines for mass housing because they change. Every couple of months, they're coming up with something new. One of the things that they've come up with recently is that they will actually give clients who qualify, they'll give them a second mortgage, in most cases up to $15,000, in some cases up to $25,000. So what they might do is they might do a first mortgage of 95% of the sales price, and then they would give the client a second mortgage for either $15,000 to $25,000. The way that these second mortgages usually work is that it's a 15-year fixed, and it's at 2% for an interest rate. So for clients who qualify, it's a pretty good mortgage program. Mass housing, they do have a lot of quirks that the agents don't necessarily need to know all the ins and outs of. That's more of my job. But depending on the city or town that the client's buying in, depending on their credit score, depending on how much income they're making, some of these things may or may not be available to every buyer. But again, it's a niche program. When the buyer fits in the box for a mass housing loan with that $25,000 second mortgage, it can be a really great way to help them get into a property.
So that's almost 100% financing.
Yeah,
right?
I think I think it works out that like I want to say under 500,000, you could conceivably do it with no money down, because you could do the 95% first mortgage, and they may give you that second mortgage for 25,000, which would be 5% of the sales price. But what I'm going to show you in the next screen is, again, kind of like we talked about with the the Home Ready and Home Possible loans, they do have income restrictions. So unfortunately, we're seeing less and less of these mass housing loans in our footprint just because you have to make more money. So as you can see here, where I highlighted in a few different counties around, their vanilla programs in most places, they're going to cap you out at 113,300 for the annual income. So this might be something where, let's say that I'm working with a client and, single woman, single guy, and they're making $107,000 a year. Well, I might know that they're not going to qualify for the last one I showed you, the Fannie Mae or the Freddie Mac Home Ready or Home Possible, because they're going to be making too much money. So I'd run numbers for this particular program for them to say, okay, we don't fit in the box for the first one because we're making too much money, but if we fit in the box for this one, let's see what the rates look like and let's see what kind of perks we get. Can we get a second mortgage for you, if need be? And what you can see here, and where I always tell people it gets a little bit tricky, is if you notice on this chart, some of these cities and towns are in bold. Like if you look in Essex County on the left-hand side, you're going to see that Lawrence and Lynn are bold. Up in the right side, you might see Cambridge, Everett, Somerville. In some of these bolded cities, the income limits can actually be higher and there are other perks. So what gets tricky when I'm working with a buyer is that, if they're looking in Essex County and they're all over the place, and I'll give you the example of like Methuen and Lawrence. A lot of clients, when they're looking in that area, they're looking at Haverhill, they're looking at Methuen, they're looking at Lawrence. Well, if they find a place in Lawrence, Lawrence is in bold. They may have more perks in Lawrence for this program than they would get in, Haverhill or Methuen, which are not in bold. So it can be a little bit tricky. And again, not to beat a dead horse, but this is why I always tell clients to start nice and early, talking to realtors, have their client reach out nice and early, because we want to get a handle on all of this stuff, especially if we feel like they're going to fall into this box, because, they could see three open houses on a weekend, and one of them could be in Lawrence where they could have, dramatically better interest rates and perks than if the next two that they see are in Haverhill and Methuen. So it's important for them to know all of that stuff going into it.
Ray, is mass housing still doing the rehab? It's like the minimal 25, 30 grand. They're still doing that?
They do that. And I think kind of like we had talked about at that class when we were in person, I think that question came up. They're doing it. You're just not seeing it come up a whole lot. It's almost like the, any rehab loans really, just in this market, you're not seeing it. I should say on the purchase side of things, you're not seeing a lot of loans that have any sort of a rehab component on a purchase, just because it's so competitive. It's already difficult to get an offer accepted with 3% down or with 5% down. If you throw on top of that the client's going to do, some sort of a rehab loan, it's a really tough sell to get those approved. Now, that being said, these programs here, when the people fit in the box, they're also available for refinances. So if somebody's in there and there's some sort of a rehab component to it, then there are programs that you can do.
They can do it as a refi. That's good.
As a refi, yeah. It's a tough sell as a purchase. You get 10 offers on a property, and somebody's probably putting 20, 30% down, and you have your offer. And even if you're $5,000 or $7,000 higher in your offer amount, but you tell them you need to do a rehab loan that could take 90 days or any kind of loan that has a quirk to it, they're probably going to go with the person who has a larger down payment. So they're good programs. They're out there. You just don't tend to see them much in this type of a market. If you go back to, sort of when we had all the short sales and foreclosures and things like that, it was more of a buyer's market. Then you would see them a lot more. People were gobbling up these houses that needed work, and the sellers were fine with sitting around waiting for a rehab loan because they were just happy to have a buyer.
Yeah, I think the people that are probably getting beat up the most in this market is the veterans.
Yeah.
Yep. Trying to put a veteran loan. You just, you hate to see that, because these guys and gals that serve for their country, they deserve to utilize the products that are available to them.
Yeah.
So
absolutely. It's tough. And we'll talk about VA loans a little bit later on in the slideshow. But I agree with you. I mean, I was talking to a realtor yesterday. We have a client together, solid client, great credit, low debt to income ratios. I mean, the perfect client on my end of things. just doesn't have a lot of cash to put down, 5% down. And I looked back and I think yesterday he got a loan, he got an offer declined yesterday. And I think that was like the 18th offer he submitted. He just can't, he's right there on price. It's just the terms, 5% down. He's losing out to people that have a lot bigger down payment. So with the VA loans, which we'll talk about in a second, you go into that and you say, I want to finance the whole purchase price. And fortunately, it's scaring the sellers.
I wonder if doing a cosign, I was just thinking if you had mom and dad that could jump in and throw some cash at the deal,
Yeah,
would that sweeten the pot a little bit,
it can. And that's a lot of what we're talking to with people. It's not always like a lot of these people will qualify. Like again, my guy that I was just mentioning, he's perfectly fine. He's a dream client for me. Paperwork is all in order, 800 credit score. It's just the down payment. So every time they submit an offer or approval letter, it's, $500,000 house, 475 loan amount, 5% down. That's the part that's getting the offer, kicked out. So cash is king. Unfortunately, I've seen a lot of people that have gone through that and they have to reach out to the parents to say, can we do something if I need to go in with, 10% down or 20% down to make it look prettier? Unfortunately for these guys, they don't have that at their disposal, but that's a lot of what we're seeing these days. It's just, it's sad, 5% down. I mean, in the real world, that's $25,000 out of this guy's pocket. That's in the real world. That's real good money. But
Yeah.
right now in this market, it's just not getting it done, unfortunately. No. Last thing to point out on mass housing. So again, when I'm working with clients, if I know that mass housing is the loan that they're going to do and they fit into that box and we've got them pre-approved for mass housing, they're typically going to be single family home or condo. Now, if you have that client who knows right from the get-go, all I want to do is look at condos and I know that they're going to go with mass housing, one of the things that I have to do a lot and before they put their offer in is I have to scrub that address of the property against the condo list for mass housing. So this is a little bit older, but mass housing comes out with one of these every month that gets updated. And this is what they would call their exclusionary list. So this is saying that they've got too many mass housing mortgages in that complex right now, and they don't want to be too overexposed in any one place. So let's look at, let's go down to Gloucester. Let's say if I had somebody who was making an offer on the Arthur Street condominium project, I would know that they can't do mass housing. Mass housing won't lend on that because depending on the size of that condo complex, they don't want to have any more than 25% of the complex. They don't want to have any more than 25% of the mortgages in that place. So if you think of your larger complexes, 100 units, they don't want to have more than 25 mortgages in there. Look at your smaller places like a 3-family that was converted into condos, you're only going to be able to do one. So again, that's one of the things that I would scrub before the offer goes in, just to make sure that the client wants to do mass housing, that they can lend on that condo. And also if they fall in love with the condo and we know we just can't do mass housing, this is where I'd want to have a backup plan for them. It doesn't, just because the condo is on that exclusionary list, that's only for mass housing. That doesn't mean it's off everybody's list. That's just that's their own internal list. But again, little things like that we have to scrub along the way when you're working with these lower down payment clients, because the condo, their income, where the property is, you can see that it all comes into play with what their options may or may not be. All right, other side of the coin. Let's go away from first-time home buyers. Let's talk about some of these clients who are buying and selling at the same time. So obviously home prices are way up. They're going to make a good chunk of change on that home that they're going to sell. But we're seeing more and more clients that, they say, well, what do I do? I'm going to sell this house for, $800,000 and I only owe $300,000. I mean, I've got $500,000 in equity sitting there, but I don't get that until, the day of the closing on the new place. So what should I do? So the first question that pops up a lot of times is, do we have any sort of bridge financing, or how can I make an offer on a property without a contingency to sell my home? So again, having that client reach out to someone like myself nice and early to go through their options, it's so important. And honestly, I think a lot of people that are selling properties, they wait too long to do that because they know they're sitting on a big pile of cash. They feel like, okay, I'm going to be fine. I'm going to have a big pile of cash to put down on my new place. But again, you got to remember that you don't get that money until the day of the closing. So one of the things that we're going through with a lot of clients when they have a place to buy and sell at the same time is the fact that they might not get an offer accepted with a contingency to sell their home. So one of the first things I have to look for with clients is, can you get into that new property? Can you qualify for both? So what we would have to do in most cases on the lending side of things is we would have to look at what their new mortgage payment is going to be. We're going to debt them for that, as well as the house that they're going to sell, even if it's on the market, because we have to assume worst case scenario. If they can, if they're making good income and they can afford both of those, then we talk a lot about ways to make an offer without a contingency to sell the home. Same thinking. It's competitive for first-time home buyers. It's also competitive for people who are moving up or downsizing. Having that word contingency in the offer can sometimes be a deal killer. So one of the things that we're looking at with a lot of people would be to kind of serve as their own what we would call like bridge loan. So let's say that think of a good example here. Let's say that somebody is going to sell a property. They know they're going to make about $300,000 on that sale. They want to buy a new home for $700,000, and they're planning on putting that whole $300,000 down. So they buy that new house for $700,000. They're planning on having a mortgage for about $400,000 when all is said and done. Now they know they're not going to get their offer accepted with a contingency. They know they're sitting on a bunch of cash. They don't have access to that right now. So one of the strategies that we've done with a lot of clients would be to give them what's called a piggyback mortgage on their new place. So what I might do is say, let's get you approved for that $400,000 mortgage that you want at the end of the day. So when everything is all said and done, you're going to have a $400,000 mortgage, but let's give you a second mortgage for X amount of dollars. So let's say that they can put down $100,000 right now before they sell their house. So they're going to buy that new house for $700,000. They've got $100,000 to work with. So they need $600,000 to buy this new house. I might give them a first mortgage for $400,000 because that's where they want to be when all is said and done. I'm going to give them a second mortgage for $200,000. And in most cases, that second mortgage is going to be what's called a home equity line of credit. You can see the acronym HELOC right there. Give them a home equity line of credit, which they can pay off or just pay down to zero once they sell their existing home. So something like this would give them the flexibility, if they qualify, to make an offer with no contingency to sell their existing home, and they can sort of right the ship afterwards. So if they have to move into this new house, March 31st, and their current place isn't going to be sold until April 30th, once all is said and done, they can take that money on April 30th, completely pay off that second mortgage or pay it down to zero, and they're just left with that $400,000 mortgage, which is kind of where they wanted to be at the end of the day anyway. So we've seen these a lot more. It's a good way to help get an offer accepted, especially in this market where the word contingency can be really difficult. That way the client doesn't have to get into a mortgage, start out at 600,000 and then refinance later on and pay that money down. So something like this, again, having the client reach out nice and early. A lot of times I like to talk to clients like this even before their house is on the market, because we can really work out strategies like this well in advance. Kind of works the same way too. If you think about, let's say that you have somebody who you're talking to today, and that they want to stay in their house like through the summer. They've got a nice pool and they've got kids that are going to college, and they just want to have that last summer in their house. And their game plan is to list the house, early September. You can almost do the same thing. If you've got time to play with, I might tell that client, go and get a home equity line of credit on your current house right now before it goes on the market, because that might allow you a larger down payment on your new house, when you're looking around in the fall. So that's one of the things that's more of a long-term play. A lot of times when you're meeting with clients and they want to list the house in the next week or two, you're not going to have time to do it that way. But when you have that long-term person who says, I'm not going to list for 4, 5, 6 months, still have them reach out to the mortgage person, because that's a strategy that we do with a lot of people, giving them a home equity line that they can have on that house that they're going to sell to allow them a larger down payment when the time comes to put an offer on that new house.
The key is they still have to qualify for both
Yep,
mortgages on a
exactly.
piggyback.
So yeah, that's the one thing. So years ago, again, I've been doing this for years, and we've years ago, between like 2001 and 2007, a lot of people would do these bridge loans, and the key to the bridge loan back then would be you had to have your house on the market. So this would be like refinancing your house that's for sale. But the mortgage person like myself, we wouldn't have to debt that property in the debt ratio. So we used to say, all right, that property's for sale. We're going to take 6 months worth of mortgage payments and set it aside in this separate escrow account. But we're not going to count that house in your debt ratios. We're going to assume that thing's going to be sold in the next 6 months. When the market turned and a lot of the foreclosures started happening, a lot of those bridge loan companies went under. Those were some of the first ones, because now they were holding the bag on 2 different properties. In this market here, to get rid of contingencies, almost everybody has to qualify carrying both properties. A lot of the banks and lenders are ultra conservative to say, we know you're going to sell your house. We know that you're not going to have any problem selling your house, but we have to be ultra conservative and debt you for both properties. We've got to assume the sky falls the day after you close and you never sell that property that you're currently in. So they would have to qualify for both places. So it is for the client who's well qualified, but we are seeing a lot of people where that's the case. A lot of people can carry both properties, or, again, when I meet clients at nice and early, if they don't, there's strategies that we can do where maybe they, pay some things off, pay off that car loan, pay off the couple of credit cards that you have. Now maybe your numbers work to, carry both properties where they didn't before. It's all about starting early. Again, I'm kind of beat that to a dead horse, but the sooner that people start, the sooner you can really lay out roadmaps like this.
And having a property under contract wouldn't change that. They would still require.
Excellent question. That's on my next slide. All right. So there are times where somebody is selling a property, they're buying a new one, where we get to a point where we don't have to debt that property against them anymore. So I'm going to pull this up so you can see it. All right, let's say that you've got this house to sell. You made the decision you're going to sell your house. It went under agreement right away. And now you're shopping for a new home. You haven't found something yet. Your buyer is well along the way of their approval. So they've got their appraisal's been done. Their loan's been underwritten. The buyer of the house that you're selling has gone past their financing date. So they're all in. They're now buying your house no matter what. If they back out, their deposit is at risk. Now this isn't going to work for all mortgages, but Fannie Mae has a guideline that would say on your new purchase. So let's say that this happens and today's the date where your buyer has given you a commitment letter. Now they're going to be past their financing date. They're past the point of no return. If you found a house this weekend and I was qualifying you for a Fannie Mae mortgage, I no longer have to debt your current house against you because your buyer is past their financing date. So we're going to treat that property as if it's sold. Again, this is something where, Freddie Mac does not have this guideline. Freddie Mac would still say we need to debt you for both properties. But in these, and we see this every now and then. I used this a couple of times last year where you might have that buyer who just decides, I'm going to sell. I don't know where I'm going yet. Maybe I have to rent for a while. But when that person's buyer gets past their financing date, there are mortgage programs where we basically don't have to count that house anymore because it's so close to being sold. All I would have to do is debt you for the new house. So it's a tool that's out there. It can be helpful.
Mm.
Yeah, it's a little bit of a niche type thing. Again, not everybody's going to fit into that. It's really for that person who has decided they're going to sell their house and they haven't found something yet. Their buyer is 3, 4, 5 weeks into it. They've got the offer accepted. They've done the appraisal. They're past the point of no return. The thinking there, and you don't see this happen very often, the thinking there is that now, if you made an offer on something, and let's say that you put, $25,000 on deposit to hold the new house, and there's no home sale contingency. If the sky fell and your buyer had to back out at the last minute, maybe they lost their job or something happened, you're going to keep their deposit because they're past their financing date. So if you in turn had to back out of the property that you were putting on, that had the offer accepted on, if that seller kept your deposit, it would end up being a wash. Again, I think I've only seen that happen once or twice in the amount of time I've been doing loans over the years, but that's kind of the thinking why they would feel comfortable, because once your buyer is past their financing date, the chances of them backing out are pretty slim. And if they do, you're probably going to keep their deposit anyway. Did that answer the question, Scott?
It did. Thank you.
All right, you got it. All right, let's talk a little bit about credit scores, because in this market these days, there's a little bit of confusion about consumer scores and FICO scores. So any mortgage lender, any banker, any auto loan company, they're going to use what's called a FICO score. And the way that those range is, as you can see on the chart here, 300 is the worst possible score, and 850 is the highest that a FICO score will go. Now, what I'll tell you is that a lot of clients these days, they're getting consumer scores. So they might have a Discover credit card or some kind of credit watch system that's giving them a quote unquote credit score. It's just important to know that the consumer score can go up to 950. So we're seeing a lot of this, unfortunately. I'll talk to clients that will say, yep, I monitor my credit, everything's good, I've got an 888 credit score. And then I have to say, well, listen, chances are your scores are going to be really good if you're getting something that says 888, but you're not getting a FICO score. Your FICO score, the highest you can get, is 850. And you're very rarely going to see 3 FICO scores that are over 800. So anything over, as you can see here on the chart, anything over 720 would be considered excellent. But again, there is a little confusion these days. And I hope that the legislature is going to button this thing up over the next couple of years to make these things match, because that the consumer is getting a little bit confused by their credit scores, especially when they might be more like in the 720 range. They might get a consumer score and say, hey, I'm at 721, 725, and then I go ahead and I do their credit report and get their FICO score, and they're at 682. They get really confused by the different scores. So if you're talking with your clients, again, that's a good place to have them reach out to a lender like myself, make sure that we're doing a credit report and getting all 3 of their credit scores from the major 3 credit bureaus. And the way that we'll do that too, just to back up for a second too, is every lender who is lending for mortgage purposes, we're going to get 3 credit scores. We're going to get one from TransUnion, one from Equifax, and one from TransUnion, Equifax, and Experian. The way that we all do it is, of those 3 scores, we toss out the highest, we toss out the lowest. So, somebody has a 750, 740, 730, we're going to toss out the highest, the lowest, we're going to go with the middle. So the middle credit score is what we would use for the file. The way it works with 2 people, or if you have even more than 2 people, let's say you have 2 couples who are coupling up on an investment property or a second home, we're going to defer to the lowest person. So we're going to go, let's say that you have 4 people who are buying a ski house together up in New Hampshire. Whoever has the lowest middle credit score, that's the one that we're going to use for the file. And that's how all lenders across the board would do that. So everybody knows that paying things on time is very important. But as you can see from this pie chart here, it's not everything that goes into your mortgage payment. So an on-time payment is really only 35% of what goes into figuring out your credit score each month. So the rest of this chart are things that when we meet with clients, especially if they're looking to fix credit or if they've never seen a credit report, this is a slide I always show people to show them what we can do to help increase their credit score if we have to. So again, everybody knows making payments on time is important. But as you can see on the second pie chart, the amount that you owe on something is almost just important. So where people make the mistake here would be on credit cards. So a lot of times I'll see people that will do their credit report and their scores aren't as high as they think they would be. 9 times out of 10, it's the balance that they have on their credit cards. So for example, let's say you have a $5,000 limit on a Chase credit card, and your balance is always up around $3,000, $3,500, and you pay it on time. You'd normally think, doing your day-to-day business, that's fine. I've had this card for 3 years. I always pay it on time. It should be good. But the problem is they're probably losing points in their credit score, because that balance of $3,000 or $3,500 on a $5,000 limit, it's over 50% of the limit. And that's a magic number in the credit scoring world. Once you go over 50% of the limit on a credit card, you might just be kind of flatlining, or you might be losing points every month, even if you're paying that on time. Obviously, the higher you go towards being maxed out, the more points you're going to lose. So, this is one that I see a lot. People will have that, Jordan's Furniture or Bob's Furniture card, where they charged, $2,000 worth of furniture, and the balance is always up around $1,700, $1,800 because they're making minimum payments. They're probably losing points on that card every month in their credit score because it's over the 50% limit. So a lot of times when I meet with clients well in advance, I can go through that with them. There's a lot of ways that we can find points for them, and I'll show you in a future slide. But 9 times out of 10, I can tell them, if you can, pay this one down under 50%. If I can tell that they're good with their credit, I might even make the recommendation of calling that creditor and saying, can you increase my credit limit? So, again, if you have that credit card with a $5,000 limit and you're always around $3,000 for a balance, you're over 50%. If you call that creditor and say, hey, I've been with you guys for 3 years, my credit limit's $5,000, any chance that we could move that up to $7,500? If the creditor does that and they move your limit up to $7,500, next billing cycle, that $3,000 balance is going to be under 50%. So you've sort of worked around the system there. That's only something that I bring up when I can tell people are really good with their credit and they're anal about it, and they just don't realize they're losing points. I never bring that up for people who are always floating around their maximum limit. It's just, you don't want to give them the gas and matches in a case like that.
Right, I was thinking about that just as you were saying it. So my thought is, would I be better off paying down my credit by the 500? Or would I be better off increasing my credit limit? Because aren't they going to do another credit check?
Well, they won't do another credit check, but think about it like, okay, we're sitting here on March 18th. You've got that $5,000 limit on your credit card and your balance is $3,000. Now, we don't know what part of the month everybody reports to the credit bureaus. So let's just say that, you have this Chase card with those numbers on it, and today is the day that they report to all 3 credit bureaus. That's the snapshot. That's the little picture in time that they're going to get. This time next month, whether you paid it down by 500 or you increased your credit limit, let's say April 18th, when that card reports to all 3 credit bureaus, that's when they're going to get that snapshot. So it only happens once a month. So it's a little tough to tell which would be better. It's really just a matter of which is going to give you the lower percentage. So if you paid that card down to, $2,490, now you're going to be about 49% exposed on that card. If they increased your credit limit up to, $7,500 or $8,000, and now you're only, 30 or 35% exposed on that card, you probably would get, a little bit more bang for your buck that way.
Yeah, no, I made that sense in my head. The only thing I was thinking is, would they take a credit inquiry? Or
No,
would they
it
just
would
take
be
my,
no, because it wouldn't be a hard inquiry. It would just be a soft inquiry with them.
I gotcha.
Yep, with that, with that credit card. Yep, absolutely. So you wouldn't lose any points for a credit inquiry.
That's all I was trying to figure out. Like,
Yep.
does it make sense to throw a few bucks on it, or does it make sense to
Yeah,
say, hey, can you increase my limit? So
and that we'll touch on that too a little bit in the next slide. So the last couple of things that go into a credit score would be 15% is the length of the credit history. So obviously, let's say you get that Chase credit card you've had for 3 years. The computer system can see that you've paid it on time for 36 straight months. That's going to hold more weight than, some new Exxon card that you've had for 3 months where you've only made 3 payments. So the longer period of time that you can show that you've been making on-time payments, the better. What they tell us in credit training is that a 6-month time frame is a good snapshot for all of the credit bureaus. They like to look at things in chunks of 6 months. So if you have that new gas card that you've only had for 3 months, you're probably not gonna get a whole lot of bang for your buck until you reach the 6-month point. Once you hit that 6-month point and it can see that you made 6 payments on time, you're going to gain some points for that. And then when you hit the 12-month point, and then 18, and so on and so on. So that the 6-month chunks of time tends to be a good demarcation for the credit scoring companies. New credit would represent about 10%. So again, same thinking. If you have something that's brand new, depending on if it's a credit card, if it's a new car payment, credit system may not know how to score you on that yet because there's just no history to it. And then the last piece here is 10% is the types of credit that you have. So when I mentioned earlier that you very rarely see people that have 3 credit scores over 800, the people that do will usually have a nice mix of credit as well. The people that I tend to see that have all 3 scores over 800 will typically have a mortgage, because a mortgage is an installment loan. It's the same amount every single month. They might have a car payment. Same thinking, installment loan, you know how much it is every single month. The payment's not going to change. You're expected to make that on time. And then they might have a couple of credit cards they use that would have what's called revolving, revolving credit, where depending on how much you might use it, your minimum payment could go up or down. The credit system likes to see that you're diligent with not only paying things that, like a mortgage or car payment, where you know the exact amount owed every single month. It also likes to see that you can pay things on time, like credit cards, where the minimum payment amount might adjust depending on any given month. All right, so a couple of things that we do. We, within our credit system, and most places have this, we would have what we call a what if simulator. So when I sit down with that client and their credit scores just, maybe they're not great, or maybe they're missing a certain point where things could be a little bit better, we can go into the credit report within the first 30 days and say, show me what we can do to gain some extra points. So I'll show you, this is one from a couple of years ago that I did. And I'll show you here, the person had a 647 credit score. And we went in and said, show us what we can do. We really needed for this person to be over 660. If I remember back, I think this was a person who was looking at a mass housing loan, and mass housing's cutoff was at 660 for a FICO score. So we went in and told it, what do we need to do to get over 660? And this is what it spit out to us. It says, change the balance on this specific account here down to 0. So in that case, we would have needed about $1,700 to pay that account down to 0. The next one required, 462, and you can see the next couple. So in this person's profile, the credit system was telling us to pay these balances down to 0. Now, it doesn't always say pay things down to 0. I actually did one for a client Wednesday. This guy had a 719 credit score. The mortgage program that he's looking at had all sorts of improvements once you got to 720. So as crazy as that sounds, in the mortgage world, 720 is a big, is kind of a big cutoff. Once you go below that, things can change. So for what this guy wanted to do, 720, just that one extra point was going to give him a lot more perks. And I think with what he wanted to do, the rate was going to be like a 0.5% lower. So I went into the what if simulator on his credit report and I said, show me what I need to do just to get over 720. And it told me to pay down one of his credit cards by like $700, which was either with real cash or taking that balance and putting it onto a credit card that didn't have as much of a limit. So in that particular example, I was able to see that it was telling me to take $758 off of this card. And when I did the math, I realized it wanted the balance on that credit card to be under 75% of the limit. So a lot of times we can micromanage these things. It doesn't always have to be somebody with bad credit, but we do have access to that. There's usually 2 different ways that we do it. It would be, show us what we need to do to get X amount of points on the credit score, or, show me, I've got $5,000 to play with. Where should I put that? So there's a lot of different ways that we can do this. It's a great tool for clients who might not be ready yet. If their credit is scratchy, we can kind of tell them, do this, make sure you pay everything on time, but here's your homework. If you can do A, B, and C, and then keep paying things on time, when we do your new credit score, you should be able to see, X amount of a point increase. So it's a really good tool to have. I'm going to skip over that. All right, so we talked about conventional loans, and again, that's going to be your, your standard, vanilla Fannie Mae, Freddie Mac type loan. Same thing on this slide. I've got to update it. Anything 770,000 or 500 or lower is going to be a conventional loan. So let's talk a little bit about loans that exceed that. So anything over 770, 500 right now in Essex County, and these things vary. So if you're working in Massachusetts and New Hampshire and Maine, every county has different limits, but I just did this for Essex County. Once you go over that, you become what's called a jumbo loan. In a jumbo loan, you can have a lot of variations. So guidelines, interest rates can really change from bank to bank and lender to lender. So just know that if you're working with that client who's looking at the, $1.5, $2 million home, and they're going to need a mortgage of $1 million or $1.2 million, they're going to be in a different category than your conventional buyer. In most cases, now not always, in most cases, when you start getting into that jumbo category, banks and lenders are usually looking for a 20% down payment. The reason being is that when you start talking about having PMI and doing, less than 20% down, PMI is more of a program for conventional loans. So you're always going to see it available on conventional loans. It's a little bit more difficult to get on jumbo loans. Now, the good thing here, of course, though, is once you start getting into that purchase price in that category, most of your people are going to have 20% down anyway. There are programs that you can do with less than 20% down, but they're more of a niche program, and they can be a little bit sensitive to credit scores and what you do for work and things of that nature. So again, this slide here, a little bit old, but this is one place to point out that once we got in the height of COVID, basically this week, 2 years ago, this was the first place in real estate where a lot of places started pulling back. If you worked with anybody who was doing jumbo financing, back in March, April, May of 2020, if they were looking at jumbo rates went, 1% to 2% higher for a while because a lot of places pulled out of the market. They just didn't know what COVID was going to do to the real estate market. They didn't know if it was going to cause prices to come down, if the market was going to crash. So a lot of these jumbo lenders, they just pulled it out of the market, and there really wasn't a good source for jumbo financing for a few months there, while we were in the middle of COVID. What I'll also tell you is, if you're working with clients that are in this category, it's important to have them keep in touch with their lender, because depending on where they're doing their financing, the size of the loan, like some lenders and some banks will require 2 appraisals when you get into what's called a super jumbo category, which can be anything from 1.5 to 2 million. Some places it's over 2.5 million. So if you're working with those really high-end clients, it's important to keep in touch with their loan officer to see, when that offer goes in, are we going to need to give the listing agent a heads up that we're going to have 2 appraisals? So that's obviously something that you want to vet out from day one, so that the agent doesn't know that doesn't think that there's something wrong. We like to let them know, based on the mortgage that this person's going to do, based on the sales price and the loan amount, you might be hearing from 2 appraisers rather than just 1. We're seeing a little bit less of that these days. Usually you get that 1 full appraisal, and then if we're doing anything behind the scenes, we can kind of do what's called like a desktop appraisal. Again, it's almost like a Zillow search on steroids. So you're seeing a lot less of the 2 appraisals needed. But on these super high-end clients that are financing 3, 4, 5 million, that can be the norm sometimes. So the other thing is that a lot of clients, again, not so much around $1 million, but when you start getting up to that 2 million, 3 million, 4 million, a lot of clients will opt to do an adjustable rate mortgage, which you'd referred to as an ARM. So talk a little bit about adjustable rate mortgages. Again, not something that you as the agent needs to know the inside and outs of, but it's just important to know the terminology and a little bit about them. So with an adjustable rate mortgage, the thing that I always want to point out to people is that on the realtor side of things, what you probably want to know about it at very least is what it means when it's advertised. So let's say that your client says, I'm going to do a 10-1 arm. All right, well, what does that mean? The 10 represents how long that mortgage is fixed in. So it's going to be figured out over 30 years, but it's going to be called a 10-1 arm. So their interest rate that they start out with is going to be fixed for the first 10 years. The 1 represents that that loan is going to change once per year. So if they sit in that loan and they never sell, they never refinance, and they're in that loan 10 years down the road, they're going to have a change date. Once per year, that loan, that interest rate is going to change. So again, that's what a 10-1 arm would be. You're going to see them advertised as a 10-1, a 7-1, a 5-1. Just know that first number represents how long the rate is locked in for how many years. And then the second number represents an annual change. There are some hokey versions out there that you might see every now and then. You might see like a 3-3 arm where it stays fixed for 3 years and then it changes every 3 years. There's actually one that's becoming a little popular now with mortgage rates going up a little bit. It's actually a 15/1. So the rate stays fixed for the first 15 years. And that's a program that I've actually, excuse me, done with a couple of clients that I like, because you're going to get a break. You're going to get a lower rate than a 30-year fixed, but to have your rate fixed in for 15 years is still a pretty long period of time, considering that most people do something on their mortgage every 5 to 7 years. So it's just important to know, and again, this is the kind of stuff that you don't necessarily need to understand the mechanics of how these things change once the loan gets to its end point, but it's just important to have a brief understanding that when a client reaches that end point, and their payment is going to change, so their adjustment date, the bank or lender can't just decide at that time to change it to whatever rate they want to. They're going to have, as you see in the middle of the slide here, they're going to have interest rate caps. So a lot of times the caps are going to be what we would call like 2 and 6. So the annual cap would be 2%, which would mean it can't go any higher or any lower than 2% from where it was the year before. So you have somebody who starts out with a rate of 4%, and then if mortgage rates are through the roof and they're back in double digits, when they get to their change point, it wouldn't be any higher than 6% the next year. So that would be 2% higher than where they were. So most of your caps are going to be 2 and 6. Annual cap is going to be 2. The 6 would represent their lifetime cap, meaning they would know going in that their interest rate would never be higher than 6% from where it started. I don't think I've ever had somebody ever get to that point. Most people that do an adjustable rate mortgage, they have some sort of a plan. They're either going to pay that mortgage off, they're going to sell, or they know they're going to refinance before that comes due. So it's not always something that we show to clients. As a loan officer, we never want to show somebody an adjustable rate just to have them get excited about the rate being lower than the 30-year fixed. Usually when we're looking at an adjustable rate, there's a reason that they're doing it. I'm doing one for a guy right now. We're doing a 7-year adjustable because he knows he's going to sell his house within 3 or 4 years. So he's going to be out of that property before that 7-year point even hits. So again, just to, you don't need to know all the ins and outs of these things, and every adjustable rate has a little bit of a different quirk to it. I would say the takeaway from something like this would just have an understanding of what that 10-1, that 7-1, that 5-1 means to the client when it comes to their financing, because that's what you're going to see on their pre-approval letter, and that's what you're going to see on their commitment letter. So we'll touch on FHA loans just a little bit. Again, this will kind of get back to some more of your lower down payment type clients. So FHA, Federal Housing Administration, it's been around for years and years. It's a great mortgage. It's a regular old 30-year fixed. The people who you will typically see do an FHA loan would be, in no particular order, somebody who has some scratches on their credit. That person who might have a 620, 640 credit score, they might be a good fit for FHA because FHA does not technically credit score. So anybody who has a 620 or 640 credit score all the way up to 850, they should get the same interest rate. So if you remember back to the slide that I showed you on PMI, excuse me, when a regular conventional loan, you know, the PMI got a lot more expensive the lower your credit score got. FHA also has one flat fee for PMI. They don't go off of credit score. So for somebody who has a 620, 641 credit score, an FHA loan might be a good recourse because they're going to get a rate that's going to be the same as if they had a good credit score, and they're not going to have to pay a premium for their monthly PMI. Next thing would be the demographic of somebody who would do FHA would be somebody who wants to put 3.5% down. Now the 3.5% down, the key thing here is it can be on a single family home all the way up to 4 family. So a lot of people who will do FHA are doing it because they want to buy a 2, 3, or 4 unit property. They have to live there. FHA is only owner occupied, but they want to buy that multifamily home with as little as 3.5% down. You can do that with FHA. If they were going to do a conventional loan, the starting point for a 2 family is 15% down, and the starting point for a 3 or 4 family is 20% down. So those are the 2 major things. When you see somebody doing FHA and you're wondering why they're going down that route, that's typically why: credit score, or they're buying a multifamily home and they want to put a lower down payment. So again, has to be owner occupied. FHA loans, regular 30-year fixed, there's no prepayment penalties. In some cases, you can have a second mortgage. So maybe that person is buying a 4 family in a Lawrence or Methuen, where they always have town money to give people to incentivize them to purchase in that city or town. They could have some grant money or a second mortgage that would sit behind their first mortgage. So that's typical with FHA as well. And then the one big thing here with FHA loans that we like to talk about that we haven't really seen a whole lot over the years is that the loan is what's called assumable. So if you see the very bottom bullet point on the slide, we're going to talk about VA loans in a second, but FHA loans and VA loans, these government loans, they are assumable. So, you know, in the height of COVID, you could do a 30-year fixed rate on an FHA loan for like 2.5%. So there's a lot of people out there that have these loans at 2.5%. Let's say that they want to go sell their property 4, 5, 6 years down the road, and the going 30-year fixed rate is at 8%. Well, they could market their property and say, Mr. and Mrs. Buyer, you can assume the mortgage that I have left on this house, the balance of my mortgage. You can assume that mortgage at the nice low 2.5% interest rate that I have, and you can take that over. So that's one of the features that FHA and VA have. Their loans are assumable, where you won't see that on a regular conventional loan or a jumbo loan. Again, with rates being so low over the last 10 to 15 years, you don't see a lot of this. But if we do go through a stretch of time where, let's say the 30-year fixed rate gets to 5 or 6% for whatever reason, and you've got these FHA clients who are selling a house with a 2.5 or 3% interest rate, you might start seeing things advertised where the buyer can take over the person's mortgage because it's assumable. So what's going to happen on something like that too? They're probably going to have a gap to fill. So if we go through a period of time where it looks like there may be a lot of loans out there that are being assumed, the buyer might have to fill the gap between what the balance is and what the sales price is. So let's say that somebody has this FHA mortgage with a balance of $350,000, but the sales price of the house is going to be 5.25. Well, that $350,000 is going to be available at that 2.5% interest rate. So that's what the buyer is going to take over, but it's going to be on them to figure out how to get the rest. It can be a down payment. It could be down payment and then maybe a second mortgage. So once these things start getting a lot more popular, I think you're going to see a lot more second mortgages come into play to say, will be a second mortgage behind that mortgage that you're assuming. So next thing, VA, we touched on this a little bit. Scott mentioned this earlier as well. VA loans are for veterans, and your typical VA loan is going to be a veteran who wants to purchase a property and finance the entire purchase price. So as you can see on the second bullet point, 100% loan to value. You don't have to. You can certainly put a down payment. You can put 5% down, 10% down, 20% down, but most of the veterans who want to use their VA loan, they want to finance the entire sales price. So it's a fantastic mortgage for a veteran. Buy a house, finance the entire purchase price. The problem is, as we talked about earlier, getting the offer accepted. A lot of sellers are really concerned about, what if it doesn't appraise? I'd love to sell my $500,000 house to this veteran. I know they're going to do a loan of $500,000, but what if it only appraises for 485? In that case, there's no backup plan. The only backup plan is lower the sales price, or you have to walk away from that buyer. So we wouldn't have the flexibility that I showed you in some of those earlier slides where, you could take on a little bit more PMI or this and that. When you have a VA buyer, there's not much recourse when the appraisal comes in low. So that's what's kind of scaring a lot of sellers and a lot of listing agents these days, which is unfortunately why we're not seeing a lot of these VA loans, get accepted. Now, let's assume that the offer does get accepted. The win-win for the veteran is the VA loan is going to be a regular 30-year fixed. The rates are going to be a little bit lower for them than the traditional buyer would get. So they're going to get a break on the interest rate. The big thing is they're not going to have to pay any monthly PMI. So they're going to save, anywhere from $100 to a few $100s of not having any PMI every month. The appraisal for VA, I always tell people, especially when they're taking their exam to get their real estate license, is an appraisal for a VA loan is not actually called an appraisal. It's called a certificate of reasonable value. You'll probably never, ever hear that referred to again, even if you're doing a VA loan. But just know that, if you do hear the term CRV or certificate of reasonable value, that's what the VA calls the appraisal process. If you do work with a buyer, I always tell people, leave a little bit of extra time. If you're doing a VA mortgage, it's not the kind that you want to be aggressive and try to, set up for a 4-week closing. You'd probably want to use the whole 45 or 60 days because a lot of the paperwork still goes through the VA. The biggest thing is the appraisal. So any bank, any lender, we sort of lose all flexibility with the appraisal when we're doing a VA mortgage because it has to get ordered through the VA website. The VA handles that. So if I have a property that's for sale in Hamilton, Mass, and then we're doing a VA loan, we order the appraisal through the VA portal. They take care of scheduling with a VA licensed appraiser to get out to the property. That report goes back through the VA. It has to get put in their system. They scrub it to make sure the property's okay. So there are a couple of places along the way where the bank or lender is going to lose a little bit of flexibility. So you always want to build in a little bit more time with those. Lastly, what I would say is that again, like we talked about with the with the FHA mortgage, a VA mortgage is assumable. So this person wants to sell 5 or 6 years down the road. Rates are a lot higher. They could market that property that the buyer could assume whatever's left on their mortgage at that nice low interest rate. But the key important thing here is that the person does not have to be a veteran. So they could be a regular old, teacher, firefighter, plumber, doesn't matter. They don't have to be a veteran. They can still qualify and assume that mortgage at the low interest rate. It doesn't have to be sold only to a veteran. So they would have still the whole pool of people to sell to. Any questions on either of those at all?
For me, I'm good.
All right. Last couple slides here. We all kind of know about the TRID rule at this point. It was put into place a few years ago at this point. Everybody knows that when you have a closing, whether it's a refinance or a purchase, that the client has to get a copy of their closing disclosure at least 3 business days prior to the closing. Now, It's pretty commonplace at this point. Again, it's not only on the purchases like you guys would see when somebody's refinancing, we have to do the same thing. They can't do their closing until they've signed that closing disclosure at least 3 days prior to the closing. The part that a lot of people don't realize is on the front end of things is we also are held to a 3-day window of time where when somebody is applying for a mortgage, we have to get them that paperwork within 3 business days. Like I had a client who had an offer accepted on Tuesday. They're getting all their application paperwork today. So once I do what's called triggering their mortgage, once they're under agreement and I have everything in there, I have the property address, I have their credit score. There's like 7 different things that we have on a loan application. Once all 7 of those fields are triggered, we get a big flashing note that pops up in our system, and most lenders have this. It will say, you must disclose this loan to the client within 3 business days. So we have it's 3 days on the front, 3 days on the back end. You know, you guys are probably more used to being cautious of that 3-day, making sure that closing disclosure is out there 3 days before the closing.
Ray,
Now,
I'm just curious, Ray, how often are you seeing that time frame missed? Like, I mean, we all know that it's required.
yep.
I would make the assumption that the lender's not missing those dates. Am I correct, or does it happen from time to
No,
time?
I don't. So I think that the closing disclosure itself, if anybody is missing that these days, you're using the wrong bank or lender, because then that's just sloppy. When this
Right.
first came out, there was a lot of confusion about, oh my God, what if something changes? Like, what if the person, you know, all of a sudden decides they want to change home insurance companies and their insurance amount is going to be $80 a month instead of 100. There was a lot of confusion about things that could change. So I know at Draper and Kramer, we try to get that out as early as possible. Because if you think about it, all of the things that need to go on a closing disclosure, you should know well in advance. You should know what the appraisal is going to charge you. You should know what the credit report cost is. You should know what the attorney is going to charge for legal services, the plot plan, the title search, their different title insurances. When we give somebody a loan estimate up front, the only thing that should change on there, and the only thing that we're really estimating, is how much their home insurance is going to be, because they're not going to know yet. And, you know, are there any changes to what the property taxes are? You know, especially like the last couple of months, like we might be giving them their loan estimate and working off of the MLS sheet or, you know, Zillow or whatnot, and using the 2020 tax amount, and maybe the 2021's just, or the 2021 or 2022, maybe the tax amount just changed. So if anybody's missing that last one and a closing is getting delayed because of the closing disclosure, that's just sloppy. The one that gets a little tricky up front from time to time can be the person who's shopping around. So remember now, when I trigger their loan, if they say, yep, Ray, we're pretty sure we're going to go with you. We're just doing we're shopping around, but let's get everything started. Once I trigger that loan, if they're not 100% on board, or if they're not 100% sure of what their loan amount is going to be, like I'll give you an example. I'm working with someone right now, and he's going back and forth trying to decide, do I want to do 10% down? Do I want to do 20% down? I got him his paperwork. I said, listen, you don't have to decide right now, but I've got 3 days to get you your paperwork. So let's just assume worst case scenario for right now. I'm going to send you all of your application paperwork because I have to within these first 3 days. I'm going to set your loan amount up at 90% loan to value, assuming you're going to do a 10% down. You're going to sign all this application paperwork, but know that you don't have to commit to that. I can always change things down the road. Just know that I have to get you something within the first 3 days by law. So that's the only tricky or confusing part sometimes up front. Where the client might be, they get ultra caution. They say, well, I don't want to sign something that says I'm going to put 10% down, or I'm going to put 20% down if I want to do less or I want to do more. So it's just on the loan officer to let them know, we just have to get you stuff by law. You have to be able to see a loan estimate within 3 days of us triggering that loan. You can still make all the changes you want, but by law, we have to get you something within the first 3 days. So that's
Do they
usually
have to
where
get it back to you within
Yeah.
3 days, or do they just
They
have to
don't have to get
acknowledge
it
they
back within
received it?
3 days. No, it just has to be hard. Like, so most of what we do up front, even when I'm meeting with clients in person, I'll usually start them electronically up front. The reason being is that it's easier to have them electronically sign up front so that they can electronically sign that closing disclosure at the end. So they don't have to sign it within 3 days, but it has to go out. So all the loan software that all the banks and lenders use these days, it has TRID software in there where it hard codes stuff. So if I'm doing a loan for Scott Gordon and I know that, I triggered it on Tuesday and I have to disclose it by Friday, once I disclose it to you and I sign that application, it gets hard coded in our system to say this went out to Scott on, Friday morning at 12:48. So we have it in our system, and that's just kind of it's a checks and balances so that, if we get audited, the client says, well, I didn't get that, we know we can show that it went out to the client, but they don't have to receive it and accept it on the front end of things. Now it's different with the closing disclosure. If for any reason that closing disclosure is going out at the 11th hour and it has to be signed, they do have to sign it within the 3 days.
Gotcha.
Okay. And that's kind of why we do it too, Scott, just in case, like if you do have it, and it's usually the client who might be a little all over the place. And, if there's any reason that they're getting their closing disclosure like a day or two before the closing, a lot of times it's easier for us. We like to have things signed electronically up front, because if I know that they're going to make changes or whatever, if we have to do anything before the closing, if they get their closing disclosure, it's easy for us to go in and say, listen, you can open this thing on your phone. With 2 clicks, you can sign it, but you have to sign that closing disclosure 3 days before the closing, or the closing is going to get delayed. If they don't electronically sign up front, then we might be looking for them to actually physically sign it. And now you get into, well, I my scanner broke, I got to go to Staples and send this back to you. So the one good thing about everything being so electronic these days is it takes a lot of that out of it. That people can just literally, if they have a smartphone, and they're relatively good with using it, they can just go in, point and click, and it's all signed. So just a couple last quick things. One of the things I like to point out, especially as we get through the winter and into spring, is Title V for septic systems. If you are working with a buyer or you have a listing where there's a septic system, you want to do a little bit of extra legwork there, make sure that people are talking to their lender. If for any reason the system fails and you think you need to do an escrow holdback, what I always tell clients is don't assume that every bank or lender can or can't do an escrow holdback. We do them at Draper and Kramer. Some local banks will do them, but even if you've done 3 or 4 in the last 10 years, don't always assume, especially if you're the listing agent, don't always assume that somebody can just do an escrow holdback, because there's a lot of banks and lenders that just won't do those. So if you do need to do a holdback, couple of things that you have to do right here, and this is pretty consistent with most lenders. You have to have approved plans for the new septic system. The reason that we need those is that we need to know the cost of the system. So if you have this $30,000 septic system that's going to go in, we need to know that the Board of Health has approved the plans and specs for that system, because if there's a $30,000 ticket on the cost of installation for that whole thing, most lenders are going to require a holdback of 1.5 times that septic system amount. So if the septic system is going to cost 30 grand, we're going to hold back from the seller $45,000 at the time of closing. So the closing can still happen, the buyer can move in, but we're going to want to see that septic system was installed and all approved and all the work has been done, usually within a timely fashion. Now, if you get into weather like we have right now, a lot of times we like to see that that's being done within 30 to 60 days. If you have a winter where we've got 2 feet of solid icy snow on the ground and they just can't get the septic system in for a longer period of time, that's acceptable. But the closing attorney is going to hold back 1.5 times the cost of that septic system from the seller until all the work is done and signed off on, and then they're going to get that money back.
Right, just a question on that.
Yep.
What if we don't know if the system passes or not? Just because maybe we've got 2 feet of snow on the ground and it's frozen and we can't do an inspection.
Yep.
Obviously, we're not going to have
Yeah.
approved plans because we don't know that it even fails.
Yeah. Then you're just, it's going to hang up the closing, because you don't really know what you're looking at, unfortunately. Because you
So
could,
the,
because you can't, because remember now, to do an escrow holdback on a lender side of things, we have to know the specifics. So we have to know, what the cost of the installation is going to be, because there has to be a number that we can work off of. Even if, sometimes you see this where you might have, everybody knows the system is going to fail, but you've got to be able to provide your bank or lender with numbers to work off of. So you have to, and this is where it got really tricky, again, going back to, how things changed with COVID. When everything shut down, a lot of these cities and towns, they weren't having their usual, meetings on things like this. And every city and town is different. So some of them meet once a month. Some of them might meet every 2 weeks. In COVID, a lot of these things got delayed. So it could take you 2, 3, 4 months even to get in front of the Board of Health with a design plan if the system failed, just to get that approved, because everything starts there. So if you can't get a test and you can't get approval on it, you're probably looking at, a cash buyer. Other than, if you're gonna sell that house and take that risk, you're probably looking at a cash buyer, because anybody that's going to finance it, if they're at a bank or a lender who's going to do a holdback, we're going to need to know all that paperwork.
makes sense. I guess I just was curious, what would you do in that situation?
Yeah, I think it could really hold you up, because if you can't test for
Yeah,
it, what do you really
yeah.
do?
Can I go shovel the backyard and
You can. It really depends.
bring
Like
a
I
hair
know,
dryer out and try to warm up the soil?
yeah. I mean, I do a lot like in Boxford, Topsfield, Georgetown, Wenham, where it's all septic systems, and we saw that back in, like, what was it, 17 or 18? Remember that winter that we had, where we had 2 feet of snow like every couple of weeks?
Yeah.
We saw that, like, a lot of people wanted to put their house on the market, but they had to hold off because they couldn't test the system. So it can be tricky.
Hmm.
So this last slide here, this is just something that I've seen, most banks and lenders will also have this overlay when they're doing a septic holdback. It's not only the approved set of plans, and then, knowing the cost so that we know how much we're going to escrow. We want to know that the system right now, although it's failed, we want to know that it's not a safety risk. So most banks and lenders would say, we want to have like a licensed plumber, or we want to have a septic company. Just give us something that says the system failed, but it's still workable. There's no hazardous risk. Most cases, the seller's been living there. They've been using, the plumbing as they normally would. So most lenders will ask for something like that, just so that they know, because again, you got to assume the buyer is going to move in. This closing is going to happen. We can't put the new system in, but we want to be able to assume the buyer is going to move in and live their life, take showers, use the plumbing as they normally would. So we need to know that there's no safety risk there. And again, most banks and lenders will ask that there's something that shows that the system is going to be put in a timely manner. You don't want to do this holdback and then, they're looking around or getting delayed with the septic company. Now it's going to go in 6 months later. Most places will ask that it be put in within 30 to 60 days. And I find that when this happens to most places, that's not usually a problem. It's usually just the septic company you're working off of their schedule. They might be 2 or 3 weeks delayed. So in most cases, when we see this, I find that it's like a 30-day window. And the closing happens at end of March. Septic system goes in mid-April, gets all signed off on end of April, and then the seller gets the leftover money from the holdback. So, but again, you don't see this much right now. We're, knock on wood, hopefully we're out of the window of major snowstorms, but that question pops up a lot as you get into November and December. What happens if we're just sitting here under 4 feet of snow for 3 months? It could certainly delay things if you can't get all your testing done. That's about it. Almost 2 hours right on the nose. It's almost like we've done this
Beautiful.
before, Scott,
I know, I know,
right?
I know. I've heard it a few times anyway.
And you're always a good student too. You always ask good questions.
Oh, thanks.
So,
Richmond gave some challenging questions too. That was good.
Yeah, oh
that was
yeah.
good.
No,
Yeah,
I bring the curveballs all the time.
exactly. Yeah. No, it's
No,
good.
this
It's
was
good. It's good.
awesome. That the lump sum PMI thing, it's probably in the back of my head somewhere,
Yeah.
but it's been such a habit for everyone to be like appraisal short, like start the negotiations and
Exactly. Yeah. And that's why I was asking you, Scott, too, if you've done appraisal things, because I think that would be, I was going to do one on my own. If you ever want to do like an appraisal gap video, we can put something together, because I think
That'd
that
be
that would be something good to have on YouTube, because you really have to, I think even though we've seen it a lot, everybody goes into that panic mode. The appraisal missed by 20 grand. What are we going to do? My buyer doesn't have $20,000. And that's, it's
Oh, I don't have
almost,
$10,000 to meet you in the middle.
it's almost never the answer. Extra money out of pocket is almost never the answer. There's a lot of ways to work around it. So it depends on the situation, depends on the buyer, but everybody goes into panic mode when that happens. And in 9 times out of 10, it's not the big issue that everybody thinks it is.
Well, Ray, I appreciate your coming and doing this for us.
Absolutely. Thanks for
Richmond,
the
thanks
insight.
for-
Always happy to do it.
No, this was awesome. Sorry, I mean, I'm sure you could produced more business in those 2 hours, but I appreciate you
okay.
staying on.
Excellent.
That was
Yeah, let me
this
know
was
if you
super-
if you have any questions. My number, all my info's here. The number you have on the screen is my cell phone. That's
Okay.
always the best way to reach me. You can always give me a call or shoot me a text. But I'd be happy to help.
Alrighty,
Awesome.
awesome.
Thanks again, Ray.
All right. Thanks,
Scott.
guys. Have a great weekend.
Hey, you too.
All right. Take care.
All right, bye.